I welcome Deepak Ladda, Chairman of the branch, to start the program. Deepak Ladda, sir, please give his welcome address. Sir.
Thank you, Secretary Ravi Shankar Reddy. Our speaker of the day, Jauman George, sir, past chairman SIRC. Sir, sir was chairman for 1920, as we all know. Sir, thank you for accepting our invitation and addressing on Saturday morning to all of us. Despite sir, daughter is in hospital, but sir is able to manage all his personal as well as professional commitment equally. A great hats off to you, sir, that you could are available with us despite your hospital in doctor. That shows the commitment of sir to our fraternity. I welcome all the members for this wonderful seminar, Company Audit 21-22. All you not need to know. As we know, there are a lot of changes in Schedule 3 and Coro, and all would have already gone understood the reading and already drafted the audit reports and Schedule 3 balance sheets which clients are preparing. But I'm sure every speaker will have a different perspective and will definitely throw insights. And this is the right time to have such kind of audit because we are in the middle of signing of balance sheets and other things. So if at all, if we're able to miss certain points which in the process we could have inadvertently missed, definitely this type of seminar will help you. I once again welcome you all and thanks speaker sir for accepting the invitation of Hyderabad branch. Sir, audience from across the country will be joining as the program is launched through DLH platform. Friends, as you all know, all these programs are being launched through DLH platform, and you also need to answer the multiple MCQs at the end of the seminar and also give the faculty feedback, which is a mandatory requirement to give CPE credit. So I request you to please be attentive during the seminar, not only for CPE, but for many points, sir will be giving, sharing his knowledge through his experts' experience over last 3 decades. So thank you all, and happy learning. Over to Secretary.
Thank you, Chairman sir, for giving our welcome address. Now I take this proud privilege to introduce one of the greatest chairmen I have ever seen in SIRC. He was my chairman because when I joined in member section in Chennai, he was the chairman. Such a wonderful person. Not only professional wise, even personality wise, I really admire him a lot. Now, I just briefly read out his profile for the benefit of members. So, Jaman K. George, he is a fellow member of the Institute of Chartered Accountants of India with over 30 years of diversified practice experience. As I told you, he was chairman during 2019-20 for SIRC. He was founder and managing partner of JVR and Associates, an 8-partner firm specializing in corporate audits and consultancy. He was his mentor Philip Macmillan Woods, a multidisciplinary accounting and consulting firm based in Dubai. He is a regular faculty for auditing in the Institute of Chartered Accountants of India. He has taught more than 10,000 CS students. He is a regular resource person on professional circuit on accounting and auditing standards and corporate audit. He has done more than 900 presentations till now. He is also a peer review trainer. He was member of the Accounting and Assurance Standard Board of ICI. He was chairman of ICI Ernakulam branch in 2002-2003. He has traveled extensively in UK, Middle East and Far East. He was past president of Rotary Cochin Central and member of various social clubs. He was honorary treasurer, Regional Sports Center, Cochin. He is secretary for Kerala Management Association during 2021-22. He is member advisory board in Saint Teres College, Ernakulam. He authored a book, Trials, Reflections of Personal and Professional Life, released in February 2021. With this brief profile, sir, once again, thank you so much for coming and addressing us. Thank you, sir. Over to you, sir.
Thank you. Good morning to all of you. The dynamic chairman of the Hyderabad branch, C. Deepak Ladda. Secretary, my former colleague, as he mentioned, at Chennai, C. Ravi Shankar Reddy. Members who have logged in with us on this Zoom platform, or those who are on YouTube and those who are on the national network. Once again, warm good morning to all of you. I'm extremely happy and delighted to be with you online though, to have this discussion or empowerment program on Company Audit 21-22, captioned as All You Need to Know. The chairman rightly said this is the right time. Some of us have completed some audits, but we still may have some doubts. And otherwise, many of the audits are still to be started, maybe halfway through. As he rightly said again, there are a lot of changes in 21-22. So we'll touch upon Schedule 3 changes as well as CARO 2020 and certain other points which I consider which are relevant from a company audit perspective as we discharge our attestation function for the financial year 21-22. So with these words of introduction, once thanking the organizers for Deepak and Ravi and their team of MC, of course, our very dear chairman in absentia, my very, very dear friend, younger brother, Chinamasan Talkayala, for coordinating this and making this happen. Let me move on to the technical parts of the presentation. I'll try to share my screen now. Is it visible, Ravi, now? Just thumbs up. Yeah. Okay, fine. Yeah, good. Thank you so much. So that is the topic. And as we see, the key aspects as far as company audit is concerned is to understand that there is a very clear statutory framework under Chapter 10 of the Companies Act 2013. Chapter 10 that deals with audit and auditors have very specific provisions for the audit and audit related matters: appointment, remuneration, qualification, disqualification, most importantly, powers and duties of auditors and auditing standards in 143 and so on. There are a lot of professional pronouncements which are relevant. Institute in the last many years have been doing a yeoman job very, very carefully, thoughtfully, and issuing standards, some of them mandatory, some of them not mandatory, and we have a large number of guidance notes for all that is relevant that professionals should do. Guidance note on certification, guidance note, of course, when talking about Schedule 3, yes, there is a revised guidance note. CARO 2020 also, we have a guidance note which has been revised in June 2022. The original version of 2020 is little outdated, and we have the latest version. So professional pronouncements here for our discussion would largely cover accounting standards from a preparation perspective, from the preparer's point of view, and the auditing standards, or as we call them, standards in auditing, from the discharge of the audit function as core professionals that we are doing it, particularly for this season, a season of change. In addition to that, we have the specific reporting requirements. In the case of a company, we have specific reporting requirements. One is CARO, which is CARO 2020 now. The other one is about the internal financial control reporting, applicable only for slightly big companies. Even CARO, there are exemptions for certain companies. Then, of course, we have Rule 11 of the Audit and Auditors Rules. There are a few points. And 143 F and G, specific reporting requirements are there. So this is the framework of the audit functions as far as the particularly 21-22 is concerned. But of course, the format of the financial statements that is found in section 129, that is the previous chapter. The chapter preceding chapter 10 naturally is chapter 9, which deals with accounts of companies. 128 is books of account. 129 is financial statements. There's a further reference about financial statements in 134. But if you look at 129, it says that the financial statements of a company should be prepared in the format given in Schedule 3, which is 3 divisions. We'll discuss that a little later. Then we discuss about the professional pronouncements and the specific reporting requirements. Any reading of the Companies Act today, I would strongly suggest we do only the e-reading of the e-book, reading of the e-book, or which is there on the MCA website. Because it's the law, and even after 9 years, it is still evolving. The company law committee is working on further changes. Ease of doing business is a key aspect. Reducing the burden of compliance, cost of compliance is another focus area. So they're all working on it, and it's still evolving. Therefore, reading a book may be misleading sometimes because changes are happening in a very dynamic environment we are. So this is a screenshot of how chapter 10 would look like when you click on the chapter 10. Quickly, we'll run through the sections on understanding, because many of us have not really gone into the specifics of the company audit, particularly this chapter after Companies Act 2013 came. We senior members, I would say senior, have completed 30 years in my profession. So we who are slightly senior has had to unlearn the Companies Act 1956 and relearn 2013. Of course, there have been some very important structural changes, but then for younger members, you have learned only 2013 Act. Therefore, do focus on these chapters. This understanding is very important. When it comes to resignation, all those things, we have technical issues. Therefore, 139 deals with appointment, 140 removal, resignation, and giving special notice. 141 is eligibility, qualifications, and disqualifications. And we have powers and duties of auditors and auditing standards. It's a very important section for the auditors. What are our rights, powers, duties? What are the things that as an auditor we are expected to, one, inquire, two, to report, and finally, auditing standards also. Auditor not to render certain services. The auditor, statutory auditor of a company cannot render multidisciplinary services, including accounting services, auditing services, loan syndication, advisory, all those things cannot be done. So that is in 144. Signing the auditor's report is fine. Attending the general meeting is okay. 147 is the punishment list. 148 is the cost audit. So this is how it would look like. That is just for an understanding. So we have the most important chapter as far as auditors are concerned, chapter 10 of Companies Act 2013. We have 10 sections, both inclusive. So with this, we will move on to the specifics, a little more of the specifics of what is going to be new. But just before that, let's also try to reinvent, just revisit rather, recap on certain basic audit processes, which I feel interacting with the members, seeing some of the financial statements audited by chartered accountants, interacting with the students every time, senior students who are into their final third year of articleship, etc., etc. I have a feeling, and that is the same feeling which most of the regulators like ROC and all that share. We hardly meet them today because everything is online. Even the stamp paper is e-stamp paper. Sometimes we make courtesy visits just to visit them, to have a cup of tea with them, either the ROC or the oil. And then that is the time they discuss that, look here, Jomon, the complaints, though these standards are prepared and promulgated by the institute. And in spite of that becoming part of the law book today, when I say part of the law book, accounting standards are mandatory under the Companies Act, under section 133, and auditing standards are mandatory under section 143, subsection 9. This understanding many of us clearly do not have. So keeping that in mind, I would let us run through some of the audit procedures which of late I feel have taken as a backseat consideration. Opening balance checking. Now, particularly when audit comes new to you, are we doing this very, very carefully? The opening balance is not just, I know in the audience there may be senior members too, but please bear with me touch upon some of the very basic aspects, which are very, very important. Opening balance checking, in fact, there's a separate standard on auditing. SA 510 deals with initial engagements opening balances. So that is the case. Therefore, we have to make sure that the balances are brought forward properly from the previous year, and that these balances are really representing assets if they are assets. For example, if there is a land account and you see a balance of 3.5 crores there, that is properly brought forward, then in the first audit, you must and you should naturally insist on seeing the original title deed, the sale deed, by which this company acquired the property, land and building or whatever. So, or allotment letter, if it's a building allotment by a local authority, etc. The original should be available. Now, today in the revised Schedule 3 as well as in CARO, the auditor has to report whether the immobile properties in the balance sheet are all held in the name of the company. If not, the details will have to be given. I was just giving one example. So for all the balances, this should be essentially done, which many of us, I don't think, are doing in the right way. Internal control evaluation and communicating to those charged with governance. So internal control evaluation today, larger companies, IFC reporting is required. But even otherwise, the first round of audit procedures. Now, let us, for this discussion, elevate ourselves to doing the audit of a, let's say, medium-sized private limited company with, let's say, turnover of 50 to 100 crores with the bank borrowings. Of course, all kinds of transactions, manufacturing company. Manufacturing, service, trade doesn't make any difference as far as this is concerned. So initially, we should do a round of internal control evaluation. Technically speaking, they are called compliance procedures. Audit procedures are broadly classified into compliance and substantive procedures. So internal control evaluation is a must. And SA 315 tells us that we should do an evaluation, understand the business of the entity, the level of controls, in order that the risk can be assessed properly. The audit risk, the risk of giving an inappropriate opinion can be substantially mitigated. That is a requirement which we see in the internal SA 315. And there's also the standard which requires us to communicate the findings with those charged with governance. Vouching. I don't know how many of us are doing this now. This may sound very old-fashioned, but voucher is a source document. At some point of time, if there are supporting documents, online verification is also possible. We're not talking about hard copy printed vouchers, handwritten vouchers, gone are those days. So the transaction level analysis, the entry level analysis is very, very important. And therefore, this is also an important exercise which audit process should cover. Ledger analysis, the individual ledgers, which are not in printout anyway. And today, most of you would agree with me that data is flying around. The client is not bothered. The moment we say that, we send the assistants either on site or we are doing from our office, then what happens is they would just share the tally data with us, with the students also. So tally data is flying around. Therefore, one has to be careful in, the confidentiality is very important. You have to make the students understand the importance of that confidentiality, because they are coming across with sensitive information. So that should be done. So ledger analysis is a mandatory thing, and with reference to the trial balance, one should essentially do. Verification of assets and liabilities, that is verification of documents of title, verification of DP statements if you have investments, verification of title deeds, RC book, title deeds for removable property, RC books if it is the vehicles and things like that. Documents of title in general, we can say that must be verified and ensured that it is in the name of the company. And if there are encumbrances, charges on the assets of the company, that should also be properly disclosed. Same is the case with liabilities, bank loans, get confirmations, get reconciliations done. All that is very, very, very important. Inventory is another area which really requires attention. Inventory physical verification is mandatory. The auditor should attend. If you look at SA 501, which is an extension of SA 500 on audit evidence, SA 501 requires that the auditor should either personally or through properly instructed assistant should oversee physical verification. It is mandatory. So we cannot take a single page statement as a stock summary, signed, not even signed. Sometimes we accept just a statement mailed across to you. A signed stock statement as physical stock. We have to make sure that the stocks inventories exist in good condition, in saleable condition, and there's no deterioration, quality and value. All those things have to be ensured. And they are all held in the possession of the company. Or so on the story goes. So verification is another mandatory exercise which we have to do. And analytical procedures, yes. Today the revised Schedule 3 requires us to give a good lot of ratios in the financial statements. Not requires us, the preparers of financial statements, to do that. But if that is not happening, then that is to be done by the preparers. But then most of the cases we are helping them in preparing the financial statements, though not very officially. It is become part of the audit exercise, unfortunately. Though strictly speaking, it is prohibited. Okay, analytical procedures are very important. Ratio analysis, trend analysis, intra-firm comparison, inter-firm comparison, and so on, that we have to really do. Comparing financial statements with books of accounts, and we must, irrespective of whether they're fully technology leverage, etc., there should be an authenticated, approved trial balance from the management, from the team, signed at least at a FM level, finance manager level. We should have this as a record. Maybe it can be a scanned copy also. So when I say a record, it doesn't mean today hard copies, but this is a must that we should do. These are very basics which are often forgotten. Another important area in an audit is accounting standards, compliance with accounting standards, and Ind AS in applicable cases. Ind AS is today applicable only for listed companies and companies with net worth exceeding 250. NBFC is also applicable. Banks, Ind AS has not been made applicable. So other companies, vast majority of our medium and small size corporate clients, The applicability is that of accounting standards, and Ind AS have not become applicable for them. Now, here again, it is because of two reasons. Only by complying with standards that we can have a fair representation, or fair presentation, fair presentation of financial statements, true and fair, cannot be a reality, cannot happen without total compliance accounting standard. Whether it is foreign exchange assets, whether it is inventories, long-term investments, fixed assets, methods of depreciation, amortization, anything that we discuss, compliance with AS is very, very important. Revenue recognition, all those things, we have to make sure that they comply. So, and again, in addition to that, the auditor, in the main body of his report, today's reporting, whether the financial statements underlying the report are in agreement with accounting standards and Ind AS in applicable cases. So something which is very, very, very important. Schedule 3 compliance, we should obtain all the relevant information for preparation notes on accounts. Schedule 3 has undergone huge changes, which is going to be our discussion, and maybe 5 minutes from now, we'll embark on specific points on Schedule 3. And lastly, and most importantly, CARO points, we have to gather the information, get the management do it. Wherever there are accountants, it is not that the auditor should do all this on his own. He should inform the auditor, and inform the management and get these data, collected or prepared by the management, and then we'll get it checked by our assistants. That's the way we should do it. Now, at this point of time, I always used to ask, I did a lot of presentations on Schedule 3 and CARO 2020 in this season. And I asked this question to our CA friends, chartered accountants, this simple question. How many of you have communicated to the clients, corporate clients, big and small, medium, all of them? I sent an email or WhatsApp saying that there are a lot of changes in Schedule 3 and giving a list of things which they have to keep it ready for the audit. I would like to have some response. You can either put it in the chat box or in the Q&A. I would highly appreciate if you do that. But the answer which I got from many of the places, no, sir, we have not done it. So what we are so used to yielding to the client and going there and doing all this work for which we do not get paid. And a fee increment is, the client will be very, very negative on that. So therefore, to the extent possible, let us get it done by the accountants. We work late into the midnight and then they leave by 5, tick off the clock, they leave. That cannot happen. This is just a common thing which has been paining me for quite some time. That we get into the shoes of the management unnecessarily and do all the doggy's job, which the accountant is supposed to do and for which he is paid for also. So that's something which one has to be careful about. And so that is with those points. Now we will now move on to see what's new. So there are a lot of changes which has happened in the recent past, like 3-4 years. But to be very specific for 21-22 financial year, what's really new is Schedule 3 revised format, and to the any schedule we travel through a section. This is the relevant section is 129. I did make a reference to that a little earlier. And then the CARO 2020, with a lot of new clauses, modified clauses, and so on. So from all this, we are going to have a Q&A towards the end, which is now a mandatory requirement by the CPA Directorate. So please stay glued to the presentation and have the answers right, so that I will also be, at the end of the session, have a feeling that has been able to drive home the point, the major changes that have happened. And in layman's terms, if I would say, of an accountant term also, that 21-22, for God's sake, let us not make it a copy-paste here. It is not a copy-paste. Lot of changes, format have to be removed. So this time I told our office team to delete all the auditor's report. And we have a repository, we call it shared bin. And in that, we have a new CARO report, the format of which I had mailed across to all the members. I hope you would have received it. Otherwise, it will be in a spam or promotions. Please do check. I had sent an editable version of CARO 2020 long back in Word format, and also editable version of Schedule 3 in editable Excel format. I hope you have received it. Otherwise, please feel free to ask me. I can always share. Now let's see what are the changes in Schedule 3, major changes. Now rounding off has become mandatory. So for a company whose turnover is less than 100 crores, the total income is less than 100 crores, figures should be rounded off to the nearest hundreds, thousands, lakhs or millions. So rounding off, there has been a lot of discussion. And I was giving this example. The figure like 1,97,326, 1,97326. If it is rounded off to the hundreds, I hold the view that it should be 1973. That 22.6 will disappear. 0.26 is not required, 1973. And if it's rounded off to the nearest thousands, it will become 197. That is my considered opinion. Open for a discussion probably towards the end of it, or either through the chat box or interactive discussion. Unmuting, you can talk, but we'll have the questions taken towards the end of it so that we have all that together. The term tangible assets on the face of the balance sheet have been now replaced with property, plant and equipment. Property, plant and equipment and tangible assets. That's a structural change, not dealing with figures. Now in the notes after the shareholding, where we are giving details of shareholders having more than 5% stake, the promoter shareholding should also be. Promoters defined in the Act, if I remember correctly, it is 287. I double check. I'll not comment on the subsection. So the promoter is one who promotes the company, plus who has substantial stake in the company. Independent directors are exempted, who has got such an important role in the direction and supervision of the company. They're all coming under the definition of promoters. We have to take a call, and promoter shareholding has to be disclosed. That's a new requirement under revised Schedule 3. Aging and date of completion of capital work in progress as well as intangibles under development. See, capital work in progress, sometimes it can happen that it remains in progress for 2, 3, 4 years. If there's an issue, the point here is to bring up if there's an issue. They're asking us to give the details of suspended projects also. For example, now in the hill stations of the southern region, particularly Kerala and Tamil Nadu, there are a lot of ecological environmental restrictions. So a project work of a resort which has been started has been issued a memo by the Tahsildar or local authority saying that construction cannot be continued because it's an ecologically fragile area, an animal track or whatever. And then this may have to be written off over a period of time, not over a period of time. Once it is completely gone and sunk, it may have to be written off. So here there is a requirement of giving the age as well as the expected date of completion of capital work in progress. Another similar item is intangibles under development. I know in Hyderabad, you may have a lot of startups who would say that, okay, we have 3-4 engineers sit together, and then they say we are coming out with a new app. Let's say an app on medical services, an app on financial literacy, an app on aggregating facilities for senior citizens. Recently, a new one has been funded by Ratan Tata. It's called Goodfellows. Goodfellows, they are floated in Mumbai to be of service to the senior citizens, particularly who are alone, not having their spouses alive or living with them. So Tata has funded it because of the social cause, and he himself is a senior citizen now. With his undying spirit, we still see him in meetings and programs. So I'm just giving this example. So these guys, what they happen is, so 1 year they will try. So end of the year, other than marketing expenses, whatever we can accumulate as intangibles under the salary paid to the engineers, the traveling expense they incur for interacting, meeting people, regulatory authorities, getting the approvals, the startup registration fees, all those things. I'm just giving an example. This can all be accumulated under intangibles under development. And finally, once the app is ready for commercialization, on the eve of that, we would accumulate this and we call it intangible assets. Okay, right. So this is the value of the app, which is represented either by capital, loan from directors, loan from outside, all those things on the balance sheet, in the balance sheet. So there also the intangibles, the date of completion as well as the aging has to be, expected date of completion has to be given. So these are the 4 changes which are there. Moving on, they have shifted, they're asking us to shift current maturities of long-term borrowings, like term loans and all that. The 12 installments which are falling from 1st April 22 to 31st March 23, together with the IFNI, which is already fallen overdue, have to be shown, cannot be shown as a long-term liability. Earlier we were showing under current liabilities, other current liabilities. Now they're asking us to show under short-term borrowings. Aging of trade payables. Now, when you look at this, when you look at the revised schedule 3, you would see the spirit of that is slightly different. They tend to give a feeling that whatever is aged and old is bad from a financial management perspective. To some extent, they are right too. So therefore, one has to be careful in analyzing the age of trade payables, etc. Just give me a minute, sir. I'm just making a reference for this only. So earlier we had only trade receivables. And now trade payables also, MSME and non-MSME, if available, has to be given separately. Trade payables are outstanding for less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. This is a classification which you have to give in a tabular form in this thing. And age of trade receivables also. Trade receivables which have been giving exceeding 6 months, other debts. Now that's not enough. Disputed, undisputed, and less than 6 months in a columnar format, 6 months to 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years, and the total. The total figure has to tally with the balance sheet. I hope the going is okay, clear. Ravi, are you there?
Yes, sir.
Yes, sir.
Audible,
Yes, sir.
clear? Pace is
Yes,
okay?
sir. Yes, sir.
Yeah. So all these changes should have been made in the revised schedule 3. And I recently, one audit got changed because of audit rotation. They're proposing to appoint us, my firm, and we just went for a visit to the client's place. I would request all of you to visit the client's place at least once in a year for many reasons. So then the audit of 22 has already been completed, but then we found that many of these compliance is not there. So the outgoing auditor is a good friend of mine, so I called up and suggested that. Then he pulled back whatever has been issued, made all these changes, including rounding off, and then reissued a setup because it had just been put before the board. The board meeting is just coming up, and AGM is going to be towards the end of September only. So we made those changes. So one has to be careful. That's where I said we cannot have this as a copy paste here. A lot of changes have to come. Now, aging of payables, receivables, and government. Yeah. Details of immobile properties held in the name of the company, not held in the name of the company. I did mention this. So we have to make sure that all the immobile properties, land and building, which is finding a place in the schedule of property, plant, and equipment, are registered in the name of the company. There cannot be any situation, according to me, there cannot be any situation other than conversion of a partnership into a company under the old Companies Act. There cannot be any situation where the immobile property title deeds are not in the name of the company. It has to be there. Only then it can be included in the balance sheet. But many of the chartered accounts have seen, agree and concur to a view that if a director is holding property and he's saying that it is going to be used for the purpose of the business, etc., then it can be treated as company's land and building. Absolutely wrong. This should not be done. For it should be shown in the balance sheet of the company. It should be transferred. Conveyancing has to be done. Stamp duty has to be paid. Mutation has to be done. And tax has to be paid in the name of the company. These many things have to be done. Only after that it can be shown in the balance sheet of the company. This many people are just showing it by passing an entry, land account letter to director's current account. Sometimes they allow shares also. This is a very common practice. If those who are familiar in the Middle East, particularly in UAE, this is a very common practice. And the bank says that, okay, the promoter has drawn a lot of money and there is no margin of promoters when we are giving a term loan, etc. Then the owner, the Emirati, would come up and say, oh, I have property in Media City and therefore you include it in the balance sheet of the company. He will just show the title deed. And then there's almost like just a one-page certificate. So then the company would pass an entry, and even Big Four auditors are agreeing that view. Middle East is a territory where these kind of considerations are not very strict and stringent, but we cannot have that done in India. I hope the point is very, very clear. I've put together certain points which are relating to tangible assets or rather property, plant and equipment. If there are revaluations which have been made during the year of assets, any of these assets, whether the revaluation is by a registered valuer under section 247. This is a very, very important. The amount of change on revaluation, if any, if there are more than 10% of the net carrying value, then the complete details of the changes in revaluation has to be highlighted. Again, in the notes on on the note on property, plant and equipment, we don't call them schedules anymore. The notes under property, plant and equipment, this should be shown. Or either as a note below that, or the figures can also be given, highlighting the changes which has happened on revaluation. Utilization of borrowings, which has been there earlier in the Caro report, now in Schedule 3 also, below long-term borrowings and current maturities of long-term borrowings, we have to make sure, or the company, and I say we have to make sure, we are still not started auditing. We are still preparing financial statements, understanding the amendments or revisions which have happened to Schedule 3, applicable from the financial year 21-22. When I say 21-22, previous year figures also will have to be reclassified, recast, aging has to be done. All the corresponding previous years have to be adjusted for the current year disclosure requirements. Okay, I hope it's clear. So utilization of borrowings is that long-term borrowings, there should be an assertion in the financial statements that they have been used only for the purposes for which they have been taken. For example, a company in Hyderabad is going for an expansion. They acquired adjacent land and want to construct a building. For it, they gave a project report to a bank, and then bank sanctioned the loan. And then based on that, the funds came in, and then the funds disappeared. The directors diverted it into real estate, or bought some luxury cars, or withdrawn some money and traveled abroad. Such things common. That's very common. There are fraudsters everywhere. Self-interest is on the highest than ever before. So one has to be extremely careful. Sirs, I need to take a short break. There's a call, so the urgent call. Please allow me just a 30 seconds break. Okay. Sirs, I'll join in 30 seconds, please.
Okay, sir. Okay, sir. Welcome, Sharon.
Secretary, sir.
Welcome to.
Sirs, I'm back. Ravi, I'm audible now.
Yes, sir. Yes, sir.
I forgot to mention in my introductory remarks, I don't know whether Naresh ji had sent me a welcome note. So we have our beloved RCMs also. Naresh Chandra Gilli, my senior colleague in the regional council, past vice chairman. Of course, we have Sunil and
Santosh, can you make sir as a panelist?
Sorry?
Santosh, I am asking our branch staff to make him as panelist, sir. Okay.
Okay, so
Okay, sir, you can continue.
My good wishes and my good regards to all my former regional council colleagues. Yeah, we'll continue. So utilization of borrowings. Yeah, utilization of borrowings is something which we have. There's a Q&A. Sir, rounding off to nearest hundred or thousands need to be done only for balance sheet and PL, even in the notes everywhere. Sir, otherwise reference will be a problem. Kiran Kumar Vanama has asked this question. So I'm just answering it right away. rounding off has to be not only in the balance sheet and P&L, all the thing. Sir, can you elaborate the rounding off of figures? What does rounding off to the nearest decimals there? Now, sir, rounding off, I did give this example. 197326, according to me, it should be 1973 if it's in hundreds. 1973, and if it's in thousands, it will become 197. Or decimals thereof. Decimals we can leave out once after this thing, point this thing, or decimals thereof. So that is, it's an option. So this is my version of the answer. That is the rounding off. I'm getting a lot of questions. Another question which is often asked is, what will we do with income tax? Income tax return. Income tax return, IT computation will have to give the full figures. We cannot have the abbreviated version or the rounded off version. That's how we are doing it. One more question. Can we not give 19 as it is? No. So rounding off is mandatory. Can we? The question is, can we not give 197326 as it is? No. Rounding off is mandatory. Why, sir? Why do you want to give it? I mean, it's easier to round off and do it. Yeah. Now, the next point, one has to be extremely careful. The client company, if they're having a working capital facility, either a cash credit or a packing credit or overdraft on receivables, etc., the banks would require mandatorily the client or their constituent to file quarterly returns of current assets with them. That is June 30th, September 30th, December 31st, and March 31st. Most of the situations we see that, though this doesn't have a huge bearing on audit function earlier, we used to see that these are all inflated figures. They have the DP intact. There may be losses, etc., but they would give stock some figure, receivable some figure. So here now in the financial statements, we have to give clearly state whether they are in agreement with the books of accounts. So let's take current assets. One is receivables, some loans and advances, and inventory. So the comparison which you have to do is get a copy of this. If it is not there, you should get it from the bank through the client. Quarterly for quarter-end returns filed with the bank has to be checked for verification. I mean, kept for verification. And then they should be compared with the quarter-end trial balance. The receivables figure, you will get it handy there. Receivables figure, you will get it handy there. Or what about stock? Inventories. Inventory is a big question. Except for very few of our clients, inventory records are never up to date. That has been my experience. In some listed companies I have seen. Sir, there's another question. Suraj Premi has asked this question. When we do rounding off, what will you do with the difference, rounding off difference? Sir, what we are doing it is here, we either add or reduce from the miscellaneous expenses as an Excel, in the Excel working. And that's it. It's not material. Let's not break our head on this. A lot of other major issues. For example, what I am discussing now is a huge issue. Rounding off is a small matter. And this is a conclusion as far as I'm open for a discussion. 1973, 197, and all this will result in some balance not tallying. That you reduce or add to the miscellaneous expenses. That's how we are doing it here. The chart also does something. We may round off at TP level to the nearest hundreds, then the same will flow into balance sheet automatically. You may use pay special values. Yeah, that's a good thing. Or simply keep another column to divide 100 using arithmetic operator. Thank you, Mr. C. Uppalapati. We have been working on something I was seeing from here. I thought, what are you working on when I'm doing this session? Now, thank you for the very valuable. Thank you so much. You are Sharan Kumar, right? Thank you. So this quarterly returns we are there. So inventories, what will we do? Stock register, if you take a printout, then we should be able to get it dynamic and not predated ones also should be possible. So stock items may be negative, etc., etc. We have many of the cases, 3-4 cases at least, we have qualified saying that there are differences and the quantum of the difference. Now the management is more of aware that they have to be careful in giving this. But sometimes just to keep the DP intact and high, they would still show inflated figures of inventory as well as this. But in the case where the records are proper, there's a system of abstraction. 1 or 2 cases we found that the audits have been completed, found that there is a system of clearly reference, an Excel sheet is prepared, and based on that is what the quarterly returns are prepared. The reporting is very clear. It's not by the auditor, it's by the preparers of financial statements. Whether in Hyderabad or Cochin, London, New York, doesn't make a difference. Public accountants or chartered accountants are always forced to assist, or probably we are the people who prepare financial statements for them, because they do not have the internal muscles, internal resources to prepare financial statements, complying with Schedule 3, accounting standards. All this is a huge challenge. The next thing is whether the company has been declared a willful defaulter. All this given in the balance sheet, okay, in the notes on accounts. Willful defaulter, if you look at the guidance note, it makes a reference to the RBI's master circular in bank audit. Willful defaulter is one who would take a loan, and 90% of the cases he would have siphoned it out or diverted it, and he will be, though he has the resources, even in spite of issuing a personal guarantee, etc., etc., there's a blatant refusal to pay the interest as well as the principal. So yesterday I got something on WhatsApp, that is a policy of Vijay Mallya that featured him, not a personal remark, but he said he made a statement that it is against my principle to pay interest, and it is against my interest to pay the principal. So both are in default. So in such situations, your company would be declared a willful default. You have to get all this in the discussions, management representation letter, and if there are so much of irregularity in the account, you can even contact the banker and then check whether there has been an issue like that. So to that extent, we'll have to go. While at this, my dear colleagues, let me tell you that some of the audit requirements we are taking for granted. We think that that's not our job, and we always hide, take shelter, or use the Kingston Cotton Mills case as an insurance policy. Delivered more than how many years back? 150 years back, where it was said that the auditor is only a watchdog, not a bloodhound. Not anymore. Given looking at the reporting responsibility, the increasing expectations of the regulator and the stakeholders, the auditor has to essentially do certain things which is expected of us. Not doing that and saying that Kingston Cotton Mills case will not sell anymore. Our own former MCS secretary from your place, I think, from Andhra Pradesh or Hyderabad, Telangana, Injeti Srinivas, he made a very shameful remark, one which puts us down really, about the audit profession. He said, we do not expect the auditors to see the needle in the haystack. There could be a needle in the haystack, which the auditor may not see, but they should see the elephant in the room. I hope the message is clear. That's a new thinking of the regulator, and unless we live up, there are a lot of possibility of being taken to task. It could be MCA, it could be NFRA, it could be disciplinary committee of the institute. And NFRA today, as you know, at least in the case of larger companies, it's really flexing its muscle and saying that we are here to regulate. And some of you would have seen the report on an IL and FS, where one of the big four firms were involved, and said that the crux of the 305-page report on IL and FS, 92,000 crore irregularity, the crux of the finding is that these auditors, in spite of being a reputed firm of huge standing, with so many multinational firms, this particular firm at least doesn't have their own thing. They overthrew their affiliates, like it could be anybody. So the large firms, Indian firms, and they say, in spite of all this, in one single sentence, the crux of that is that they failed to obtain sufficient appropriate evidence in all that is relevant, confirmations from loans outstanding, customer receivables, nothing. And finally, a mammoth like IL&FS is having all kinds of problems. Investors' money is at stake, public money is at stake, regulators' dues are overdue, and so on. So that is very important. And the last point in this slide is whether registration satisfaction of charges have been filed on time. The new regime, those who are in company law practice, know CHG1 is a form which we use for filing registration of charges, for which you have 120 days today from the date of the loan agreement, and for satisfaction 30 days. The point to be reported here is that whether these satisfaction or registration have been filed on time. If not, then it cannot be filed with later time. You have to go to the RD and get it done. I hope you know the procedure. But here the point is whether they have been filed on time. If yes, you say that yes, a charge has been registered on time or satisfied on time, and so on, so on. Full details of loans and advances to related parties. Of course, by virtue of AS 80, AS 18, we are giving the complete details of transactions with related parties, right? AS 18, related party disclosures, accounting standard when we comply. In the notes on accounts, we are giving this. But in addition to that, the Schedule 3 is reminding us to give full details of loans and advances. Not all the transactions, only loans and advances. Whether any proceedings have been initiated against the company under the Benami Transactions Prohibition Act. If there are irregular transactions, one may smell the rat, find that there could be some irregularity. One has to dig deep, make deep dives, and check whether there have been transactions of this sort. Management representation letter, this should be included. And the guidance note also asks us to scrutinize the legal charges account, because company may say, no, there is nothing like that. But if you scrutinize the legal charges, you would come across a payment to an advocate. And you look at the bill, it would say that for representing the client under the Benami Transaction Prohibition Act. So, then it really explodes. And you know how to take it forward from there. Whether the company has acted as an intermediary in a money laundering transaction. See, this I made it very brief. If you look at this very long paragraph, I'll give this example. I've been giving this example that a company in Hyderabad, for example, a company sitting in Hyderabad, for example, would receive an amount from a UAE company. Any country for that matter. I'm just saying our neighbor, we have a lot of transactions with them, a UAE company receiving, let's say, 5 crores of rupees. There's no regular business transaction with this particular company. With an instruction that you take 10% of it and balance amount of 4.5 crores may be given to another company in Sri Lanka. Okay. I'm just giving this is a foreign entity, foreign transaction. It could be a company in Kerala giving you some money, asking you to transfer to Delhi company. Or even a Tamil Nadu company, whatever. So this is something like a money laundering thing. And whether the company has received, loaned, advanced any amount, which is the character of a money laundering transaction, is a point which you have to give. So you have to scan through the ledger accounts and see there are no irregular transactions, one-off transactions, as they say, one-off transaction, and therefore this is to be kept in mind. Details of transactions with struck-off companies. It is possible that you would get into a transaction which is more of a sham, and based on that you would do some transactions, siphon money out, receive money, etc. So again, when you scan through the ledger, if there are one-off transactions, one has to see, and you also have the freedom of checking on the MCA website by name search or CIN search, CIN search, whether this is such kind of transactions have happened, and this has to be given in the. So where do we give all this? There are a lot of general points. So what we have done, or those who have received the format which we have prepared, it is shown under a new caption called other regulatory information, additional regulatory information. Additional regulatory information which comes just below the last clause on the notes on accounts, which all of us know. Previous year figures have been regrouped, recast wherever necessary to suit current year's name. Just before that, we also used to have a COVID clause which can be lifted now, which can be done away with now in the given circumstances. So with that, we have to give the complete details. Now we're going to see all this. Whether the provisions of section 2, subsection 87 on the number of layers have been complied with. Under the Companies Act 2013, in a vertical form of holding, a company cannot have more than 2 subsidiaries. A company can have B as its subsidiary and B can have C as its subsidiary. So A becomes a parent holding company. So this is a principle, not more than, so D cannot be there vertically. Horizontally, you can have as many as possible, there's no problem. So this is vertical, and therefore, but at some level, if at any level, if it's 100% subsidiary, then you can go for one more level. I'll give this example. A company floats 100% subsidiary B. B can have C and C can have D also. Otherwise, A, B, C, that's all. If B or C is 100% subsidiary, then it can happen that we can go to the 4th layer also. 1 plus 2 will become 1 plus 3. I hope this is clear. And that is another requirement. Full details of CSR expenses. If CSR is applicable, yes, you have to give the complete details of amount spent, amount unspent, etc., etc. Full details of that has to be given in the notes. Please go through the guidance note. In a short span of 2 hours, we cannot complete all that in detail. I'm giving certain things which are only pointers, which you have to read further from the guidance notes of the institute, which is just available for a download. Go to the ICA website, and under resources, you'll have that. Or you can Google up also, you can get it directly. So CSR came in as a very friendly section, but today there are a lot of responsibilities of CSR. CSR is mandatory, penalties for non-compliance, accounting has to be done. If amount committed, procured to be spent is not spent, then the amount unspent has to be specifically given. Provision has to be made for accounting hit. It will take an accounting hit. That's a new change for the amount not spent on CSR. Oh, details of crypto transactions. Now that is the new thing, which is a fad now. Corporate might also enter into crypto transactions. So when last budget, when Madam Nirmala Madam said we are going to tax VDS at the rate of 30%. VDS, I hope you know the term, virtual digital assets, which contains all these cryptocurrencies, unregulated, all these virtual currencies and assets. VDS is a new term, virtual digital assets, 30%. All these crypto exchanges, guys said, oh, finally we have been legalized. And she made it very clear that taxing doesn't mean you are legal. We still do not call it legal, but the taxman not looks at the legality, taxman looks at the taxability of it. If you make a profit, yes, you will have to pay tax. So that's a complete details of crypto transactions have to be given, profits made, amount invested, etc., etc. Now look at these ratios. All these ratios are to be given in the notes of accounts. Current ratio, debt equity ratio, debt service coverage ratio. Those who are in the field of financial consulting, loan syndication, and all those things we know. Debt service coverage ratio is a repayment capability. PAT plus depreciation, or rather PAT plus non-cash expenses plus interest. The total is divided by your repayment commitment, or the total of 12 EMIs. That will give you the debt service coverage ratio. Return on equity, that is PAT divided by equity capital and reserves. Inventory turnover, trade receivables, trade payable turnover ratio. We used to say that inventory is a numerator. No, it's not so. It is inventory turnover ratio is the total turnover divided by average inventory. Trade receivables is total credit sales divided by average receivables. Payables similar way. Net capital turnover ratio. Net capital turnover ratio, yes. Net profit ratio, we know. ROC, return on capital employed. Return on investment. Return on investment alone, don't look at the guidance note. It's quite confusing. They have given it from an investor's perspective, some sigma and all that. Return on investment is nothing but your PAT divided by the total assets. Total assets, that's it. That is return on investment. Now, if there are variations, naturally, as I mentioned earlier, the previous year figures also have to be given. So, if there's a variation more than 25% during the year, then the reasons will also have to be explained. Again, we are giving in a tabular form under other regulatory information. Now, in the P&L, there are a few changes. The term revenue, total revenue is now replaced with total income. Grants and donations received, a new line has been included for Section 8 companies. The third point is to give details of unrecorded transactions surrendered, disclosed in income tax assessments. This is a reporting requirement in Schedule 3. Many of them which are there in Schedule 3, new Schedule 3, find a place in revised CARO also. Now, it can happen that during the financial year 21-22, there has been an income tax search or a major assessment also. 143.3 also will come under the purview of this. It's not just a search and seizure assessment, block assessment. Well, to cut the long story short, I'll give this example that there's a search in early, let's say, April 21, and the assessment is completed and you have the final assessment order by Jan 2022. So both happens in the financial year 21, the process initiated, the assessment is completed, etc. Hypothetically, normally it doesn't happen that fast. All of us know. Now, the findings during the income tax raid, as we call it, or the search was that everything is okay, except that the title deed of a landed property for, let's say, 2 crores. 2 crores value of landed property, one title deed was unearthed, detected. Everything else is okay, explained properly. So this 2 crores is getting assessed. And if that's getting assessed, the requirement is that accounting sense, if it prevails, then it has to be brought into the books. It is a property of the company and it has not been recorded because it was occurred out of unrecorded transactions, maybe accumulated income, etc. So therefore, this has to be accounted for. I was asking this question in most of the live sessions where we had physical meetings. We had what is the accounting entry we have to pass. So there were mixed responses. Finally, the general consensus is that entry should be land account debtor 2 crores. And if it's taxed at 60%, let's say the tax demand is 1.2 crores, to provision for taxation 1.2, and balance 80 lakhs will be credited to revenue P&L account. That has to be done. And that is what this question is. To give details of unrecorded transactions surrendered, disclosed in IT assessment. That has to be given. And that has to be given as a separate line item in the P&L account. So this brings us to the end of the Schedule 3 changes, which we have completed in about 10-12 slides. But one has to really apply the mind. The format is with you. Some of you would have done it, but critically evaluate. That's what I was doing. In one case, I was just making a small correction while doing this presentation. One of the draft financial statements which will come for my verification by the senior assistant. So P&L, this many are there. Balance sheet, a lot of changes. Some are presentation related, some are aging related, some are disclosure related, and so on. The story goes. So I think with that we can go to Caro with your permission. Let me see whether there are any questions in the chat box. Okay.
No questions, sir.
Okay. Good. No tea break, Ravi? Tea, coffee, snacks?
Yes, sir. Sure. Sure, sir. 5 minutes back, we can take, sir.
No need, we'll go on. We'll take a few questions in order to avoid the monotony of a long talk. If there are some questions, you can ask the members. You can either unmute them, the admin can unmute them.
Members who want to ask any questions, please raise your hands so that we can make them panelists to ask. I think nobody is raising their hands.
No questions means 2 things, Ravi. One is they understood everything. Otherwise, you know what it is. Question, request you to please share audit report and Schedule 3 format. Okay.
Yes, sir. Audit report, Schedule 3 format.
Yeah, I'll give my mail ID towards the end of the session. No other intention, just to share information. And then you can shoot a mail. In reply to that, I will share the audit report as well as Schedule 3 format. Then we'll go to Caro then.
Yes, sir.
Yes, sir.
So having completed Schedule 3 revisions and understood the new reporting disclosure requirements, in the right sequence, we will move on to CARO 2020, which is notified as early as 25th February to 2020. Initially, there was a feeling that 1920 would be applicable. It did not happen. 2021 also it got deferred. And finally, from the financial year 21-22, CARO is applicable, 2020. The overview of the order is there are 7 new clauses. There are 7 new clauses, 7 modified clauses, and 7 clauses have been retained as it is from CARO 2016, which we are quite used to. Put together, there are 21 clauses and 47 subclauses. Please, listen or rather read and digest the slide because Q&A, I'm giving a clue. In Q&A, I have some questions from here. Okay. 7 new clauses, 7 modified clauses, 7 clauses retained as it is, and 21, and plus in that 21, within 21, we have 47 subclauses. summary of changes, if you see, let us look at the first column, which is newly added clauses. The first one is transactions not recorded in the books of account. We just 1 minute back we discussed, probably as the last item in Schedule 3. Income tax search rate, 2 crores example that we discussed. The second new requirement is ability of the company to pay its liabilities within 1 year as and when they fall due. This is a challenging clause, a new requirement, additional requirement, asking the auditor to have foresight into the future based on financial ratios. Based on financial ratios. Financial ratios and the position of current assets, current liabilities, etc. The auditor has to report. That's a new reporting requirement. CSR, I did mention, they are bringing onerous responsibilities on the auditors also to comment on the CSR amount spent. And here specifically it is to see whether the unspent amount has been transferred to a central fund or earmarked bank account, as the case has in 135.5 and 135.6. We will see as we go by. Statutory audit resignation. If you are coming in filling the vacancy of a statutory auditor caused by resignation, you have to have in-depth, clear communication with the previous auditor, understand what were his concerns and what led to the resignation, etc. Consolidated financial statements, reference to negative remarks in subsidiary CARO. See, CARO does not apply to consolidated financial statements or consolidated financial reporting rather. But if there are negative remarks in the competent auditor's report, either a subsidiary or an associate, that has to be highlighted by the holding company auditor in this consolidated financial statements report. Internal audit system, the requirement of that, and also seeing the report has been reintroduced from CARO 2003. After how many years? 17 years. Then cash flows, that point also has been reintroduced. So these are the 7 new clauses. There are amendments to fixed assets clause, inventory clause, repayment of loans granted by company, default of repayment in dues, reporting of frauds. Nidhi company, there are a few reporting new points. Registration with RBI, again some amendments. Deposits, cost records, loans and investments 185 and 186. Application of funds raised, related party transactions, non-cash transactions with the directors KMP, payment of statutory dues, etc. are retained as it is. So 777, it's easy to remember. 21 clauses. So when you finally look at the draft of the auditor's report, a CARO report where applicable, before generating the UDIN, etc., you have to make sure that there are 21 clauses. But if there are some clauses which are not applicable, you can say that clauses 13, 18, clauses 13, 18, 17, 18 are not applicable to the company. Like that you can give. Also where CARO is not applicable, which you are going to see now, to whom CARO is not applicable. Effective from for accounting periods commencing on or after 1st April 21, every company, including a foreign company, its branch, government company, all branches where parent is subject to CARO, applicable, CARO is applicable, branches also will apply. Exemptions are banking, insurance, Section 8 company, 1-person company, small company defined at 285 of the Companies Act 2013. Okay. Now, while in this, I would just quickly, let's recap the definition of a small company, which has undergone 2 changes. One is very important, that the limits have been enhanced substantially. 285 says that a small company means a private limited company whose paid up capital does not exceed to 50 lakhs earlier, now it is 2 crores. 2 crores, paid up capital does not exceed 2 crores, and it is not or, and the turnover as per the latest audited accounts does not exceed 20 crores. Okay, 2 crores and 20 crores, easy to remember. And means both the conditions have to be cumulatively satisfied to be a small company. Neither your capital should exceed 2 crores, nor your turnover exceeds 20 crores. Only then you are a small company. If you are a small company, CARO is not applicable. So in the auditor's report, The last part of it, we'll say that the company being a small company as defined under 285 of the Companies Act 2013, CARO 2020 is not applicable. Give just 2 lines so that one should not have a feeling that we have not applied our mind. Yes, we did, and because this being a small company, CARO is not applicable. Now we'll discuss 7 new clauses first. Internal audit system, so far they said whether the company has an internal audit system commensurate with the size and the nature of its business. This was the only requirement which was there in CARO 2003, which is reintroduced. In addition to which, very sensibly, I would say very sensibly, otherwise internal audit or report on internal audit was just a farce. Very sensibly, they are asking the statutory auditor whether the reports of the internal auditor for the period under audit were considered by. So whenever we ask if there's internal audit, management would say, yes, sir, we have an internal audit. Where is the internal auditor? That corner, that person sitting there, he is accountant come internal auditor. Then you ask whether a discussion or reports are issued. No, sir, every day we are discussing. So almost like concurrent audit. This is not relevant anymore. If there are internal audits, internal reports should be there. Statutory auditor has to say that we have whether he has considered the reports of the internal audit. If it's not there, we'll have to say no. The internal audit reports where we are informed that there's an internal audit system, but we are rather, but internal audit reports were not available for our going out of charge. Screen is bright or not? Okay, right. You can see the slides now. I'm audible, clear, Ravi?
Yes, sir. Yes, sir.
Okay, right. Now, cash loss, there's nothing much. Whether the company has incurred cash losses in the financial year and in the immediately preceding financial year, if so, state the amount of cash losses. Okay, nothing much to be explained here. This is again reintroduced from CARO 2003. Unrecorded income, we did discuss this. Whether any transactions not recorded in the books of accounts have been surrendered or disclosed as income during the year in the tax assessments under the Income Tax Act 1961. If yes, whether previously unrecorded income has been properly recorded in the books of accounts during the year. Specifically, they're asking whether this has been captured in the books of accounts, accounting entry has been passed. We had explained with the example, the 2 crore example. It should be done at this point number, new clause number 3 in CARO. Clause number 4, new clause, whether there has been any resignation of the statutory auditors during the year. If so, whether the auditor has taken into consideration the issues, objections, or concerns raised by the outgoing auditors. This is a reporting requirement. As my comments on that, I have written, let us document concerns raised by the outgoing auditor in the audit report, otherwise communication before accepting the engagement, discussions and communication with those charged with the governance. We should have a threadbare discussion with the outgoing auditor and take his views and the reasons, the issues involved, etc., etc. And also we have to include specifically in the MR, management representation letter. This again is something which many of us, vast majority of us, are not obtaining from the management. See, today I was just showing a client of mine. This thick is the documentation which is required for a small private limited company, including the IT computation, the auditor's report, the schedules, the notes, the letter of representation. This is running about 30 pages. Groupings, all those things. I'm just showing this. It's a draft stage it is. And then we had a discussion this morning with that particular client. And so this we cannot, there's no shortcut to that. Take a printout for the discussion, and after some time, many of the things will get digitized. But there are still, we still live in a hard copy world. So management representation letter should be obtained in all audits. If you look at SA 580, written representations, SA 580. And again telling you, SA 580, all essays, standards on auditing, are mandatory not only as a dictum of the institute, but also, I repeat, also has a very strong provision under the Companies Act 2013, Section 143(9). And not surprisingly, 143 is captioned as powers and duties of auditors and auditing standards. The caption of the section, that shows the importance. And level of compliance, unfortunate to say, I'm not getting a instructional here. Out of my continued observations, discussion with the members, students, and saying level of awareness about standards and auditing and the application is dismally poor. People who are in the administration, Deepak, chairman, all of them are in the managing committee would agree that the CP committee 2 years back had made two aspects mandatory for program organizing units as for CP meetings. One was revised code of ethics, which is applicable from July 21. Revised code of ethics, and the other one was standards and auditing. Sessions would have happened, but then there won't have been much of attendance because people are not bothered about it. It's a one-time thing which you have to comply. So do get management representation letters in all that is relevant and about the assertions which they make during the course of the audit. Now, this is capability of meeting its liabilities. Okay. On the basis of financial ratios, aging, expected dates, etc., discussion with the board of directors, whether the auditor is of the opinion that no material uncertainty exists as on the date of the audit report, that the company is capable of meeting its liabilities existing at the date of the balance sheet date as and when they fall due within a period of 1 year from the balance sheet date. Within a period of 1 year only. But again, we are to see whether the company will be able to pay its liabilities. Like it involves some bit of forecasting. So in lighter vein, one of the sessions I was saying, anyway, the syllabus of the institute, CA course, is getting thoroughly amended, changed. So why don't we also add a 20 marks paper on astrology for future chartered accountants who are getting into practice to opine on this. This is on a lighter note, but let us gather all the information that is relevant. Let us look at the financial ratios, which are now handy available at the end of the financial statements. You don't have to calculate it separately. And based on that, position of liabilities, liquidity position, all those things, whether we can. It can go wrong. The statement made by the auditor can go wrong, but as long as the auditor has based it on reliable, conclusive evidence, which he has then he can, of course, even if there's a charge against him, he can easily come out acquitted. There's absolutely no problem. But we cannot give this a blind shot. One has to be extremely judicious, collect all that is relevant, get representations from the management, and look at the subsequent transactions also, subsequent events. See, when we are today finalizing about an audit, we have come past almost 5.5 months. Sorry, 5 months. Today is 3rd September. 5 months into this subsequent financial, which is 22-23, where we are in. We are doing the audit of 21-22. So you can see whether at least half of the year these transactions, liabilities are being serviced, or they're accumulating debt, or they're in a debt trap, etc., etc. Then one has to be careful in reporting on this. So I'm suggesting that we get written representation on realizability of receivables, financial assets, board's documentation of review of liability position, etc. Include specifically that all the material events, transactions post balance sheet date, but before report date could impact paying capacity has been communicated to the auditor. See. Since it's Hyderabad, the smaller branches, I was skipping this, but this needs to be explained. So the CSR projects, once it's applicable, the CSR is applicable if turnover exceeds 1,000 crores, net worth is 500 crores, and turnover net profit exceeds 5 crores. If that happens in a particular year, this company will come into the ambit or applicability of Section 135, read with Schedule 7. CSR spending would be mandatory. To form the CSR committee, would advise the board, etc., etc. And the amount to be spent is 2% of the average net profits of the 3 preceding years. Okay. Now, 2%. Now, this is mandatory. So, 135.5 says that if you have other than ongoing projects, let me explain what an ongoing project is. That should have come first. Ongoing project is a project which CSR project which this company takes up, which will go beyond 1 year. Multi-year projects of not more than 3 years. That's the term they have used. Multi-year projects which will not exceed term of 3 years. More than 3 years, you cannot have CSR projects. It has to be completed within 3 years. So what can happen is as on 31/22, if 21/22 is the first year when CSR became applicable, as on 31st March 22, you will have, let's say, your earmarked of the total requirement of 5 crores of spending. You said 3 crores, 4 crores for ongoing projects. Setting up a huge sanitation project in a remote village in Telangana or Andhra Pradesh, and it is saying that, okay, sanitation plus, maternity center plus Anganwadi, etc., huge project. And you're saying the 4 crores will be spent over 21/22, 22/23, 23/24. Okay, 3 years you have to complete. So as of 31st March 2022, out of the 4 crores, let's say you have spent only 2.5 crores. Balance 1.5 crores is an ongoing project. Balance 1.5 crores will have to be within 30 days from the end of the year, deposited in earmarked bank account to be used for that balance 1.5 crores should be put in that bank account and used only for this particular CSR project. That will also require CSR certification, validation. Is that clear? That is about ongoing projects. So out of the 5 crores, you had this thing, 4 crores you are spending for ongoing projects. 1 crore is for other than ongoing projects, meaning those are the things you should spend in 21/22 itself, current year, 21/22 itself we will spend. But unfortunately, of the 1 crore, due to various reasons, you could spend only 80 lakhs on worthy CSR projects. Then the balance 20 lakhs will have to be, it is gone. You cannot keep it with you. Within 6 months from the financial year, you have to give it to any of the funds which are mentioned in Schedule 7, like Prime Minister's Relief Fund, Chief Minister's Disaster Relief Fund, etc. It has to be transferred. It will never come back to you. Because that is the inefficiency. You should have spent on other than ongoing projects 1 crore during the financial year, which you had committed yourself. The CSR committee as well as the board resolved that we would spend it, but that did not happen. Okay, so that is to be, they'll go to the government fund. The auditor's reporting requirement is whether these have been actually complied with. These requirements have been complied with. Caro remarks of other auditors, we did mention. Consolidated financial reporting, Caro is not applicable. You only give the main body of the report. The formats are there. But if there are negative remarks of this thing, the auditor of the holding company who prepares the, or rather who audits the CFS will give those negative remarks, should be given in the CFS audit report. Is it clear? So with that, we have completed all the new clauses which are reported under CARO 2020. We will try to touch upon some of the very important points which are not purely CARO and Schedule 3. And then if time permits, come back and visit the modified clauses also. Now, what's the next one? In addition to the amendments in CARO, this year there is an amendment to Rule 11 of the Audit and Auditors Rules 2014. This is in relation to the point which we discussed in Schedule 3. Whether the management has represented that no funds other than disclosed in the financial statements have been advance received by the company with an understanding that such amount be lent invested on behalf of the party to in any person ultimate beneficiaries. The example which I gave you, that is UAE company giving funds to a Kerala company or a Hyderabad company, asking us to transmit further to Sri Lanka, etc., etc. This will come under that. And is there anything that caused him to believe that the representations are misstated? Whether the management has represented. So management has represented matlab, is it oral? No, it should be a written representation. In that we should say that no such things have been other way of discuss everything. And other than what is disclosed in the financial statements, there is nothing. Or rather, what we have given you is a complete, total picture of all the transactions, all the balances, all the assets, all the liabilities, etc. And there are nothing which is this kind of a sham transaction, which is a smell of a money laundering transaction, has not happened. And the auditor should ensure that we should be firmly believe that the statement is the representation is not misstated. This is a very, very important point. It's not under CARO, but this will come under the other legal and regulatory requirement. Many of the members had left this out. And one more point there, whether dividend declared or paid during the year is in accordance with section 123 of the Act. So it is not Schedule 3, it's not CARO. This is an amendment which has happened to Rule 11 of the Company's Audit and Auditors Report Rules 2014. The Act came in 2013, and most of the rules, they took about a year to frame the rules. And why the rules? Because the Act, though we said it's a simplified version, in 360 plus places, the Companies Act 2013 says, as may be prescribed. And the prescriptions are found in the rules. You look at the definition of a relative, half of it you will find in schedule, in the Act and balance in the rules. Very unfortunate. Definition should be self-contained either in the Act or in the rules. Half here and half there makes reference so difficult. And for the students also, it is confused reading. So these are very important things. And while at dividend, before we move on to certain other aspects, dividend, proposed dividend is no more concerned. See, earlier, before 2016, this is effective from 2016, proposed dividend when the board recommends a dividend, assuming that this week the board is meeting to approve the financial statements of 21-22, and they are recommending a dividend of 10%. So the capital of the company is 5 crores, so 10% would become 50 lakhs. Now there is TDS also on dividend, etc., etc. So a recommendation at this point of time. Earlier we used to go back to 31st March 2022 before finalization and say proposed dividend. And those days we used to show CDT also, corporate dividend tax. That is gone now. But revised AS4 states that proposed dividend should not be considered because the recommendation of dividend, technically the recommendation of dividend by the board now is not an adjusting event as far as 21-22 financial year is concerned. That will become a definite liability only when it is subsequently declared in the AGM and then paid. Okay, declared primarily. Payment can be maybe a little later. So in this case, accounting entry will not be passed. The board will be very loud in the board's report. In the notes on accounts also, there should be mention about the dividend declared. I hope I made point clear. So we had an introduction. Let us recap. We had an introduction. The processes were reviewed. The the framework was reviewed. Companies Act, professional pronouncements, additional reporting requirements. Then we moved on to have a threadbare discussion on what is new, that is revised schedule, amended schedule 3 and CARO 2020. And then we discuss this amendment to Rule 11, which again applicable from 21-22. A few things which are of relevance, which I thought. Many of the members leave out this cash flow statements. See, today, by virtue of the definition under 2 subsection 40 of the Companies Act, all companies except small, dormant, and OPCs must prepare cash flow statements. Small company definition we have seen, 2 subsection 85. Paid up capital 2 crores, turnover 20 crores, it should not exceed. Cash flow statements must be mandatory. Some of our members have not got sight of this and not preparing cash flow statements. So the definition of general purpose cash flow statements include cash flows also. Depreciation, I hope you know that it is a not arbitrary rates. You may Google up and get it, but if you look at Schedule 2, it talks about the useful lives, and the residual value of 5% is arbitrarily fixed. The question arises here: can I have a different useful life? Useful life which is different or at variance from what is mentioned in Schedule 2? The answer is yes, based on technical evaluation. Companies like Infosys annual report, if you read, of course, they are under Ind AS, but when it comes to depreciation under the Companies Act, they are saying that they are following for certain assets, yes, But for computer systems and all that, they are using a lesser useful life than what is given in this schedule 2. Component accounting will jump off. For intangible assets, the application principles are, the amortization principles are as in AS 26, accounting standard 26, intangible assets, which is that there is a rebuttable presumption that the useful life of an intangible asset will not exceed 10 years. It will not exceed 10 years. If it is computer software or web design charges, etc., it will be 5 years, not 10 years. That's a cardinal principle. So, accounting standards, all accounting standards will apply. I put a question mark purposely to have an interaction. If it was physical meeting, we could have had more of interaction. Here, due to technicality, I think, or maybe members are shying away, that there are no responses. I've been talking for almost 1.5 months, 1.5 hours now. Interim dividend is declared and paid during the financial year, subject to final dividend ratifications in AGM. In such case, so we should be, yes, interim dividends, yes, sir. Interim dividends is 21-22, it is declared and paid, everything has happened. That will be shown as a bracketed item from your reserves. And there's also, that's your observation is right. Interim dividend, I was talking about final dividend. Interim dividend, yes, it has to be accounted for. And for dividend now, TDS is also there because having made taxable, CDT gone, plus TDS on dividend also. So accounting standards, I was expecting a question answer there. How many accounting standards are there now?
Somebody answered 29, sir.
29. Yeah. That is Venkataramana Murthy Palagi. Yes, sir. Thank you. We have 29 standards, but let us know that out of that, 2 have been withdrawn. So effectively, we have only 29 minus 2. But people like Ravi sitting at the institute did not renumber that. So we still have 29 standards.
I'm doing my India course, sir, now. It's progress.
Oh, very, very good. All the best. Good. Keep learning. Yeah. Okay. Now, one more chat is come. Okay. Depreciation and other deleted, yes, sir. Yeah. Depreciation, yeah, AS6 has been deleted. You are right, sir. And AS8 also was withdrawn long back. AS8 was on research and development. That is withdrawn. And when AS26 came on intangible assets, they have said, okay, they said, they said that will be merged within AS26, intangible assets. R&D, there is no separate standard. Similarly, depreciation AS6 has also been withdrawn by the company's accounting standards amendment rules. I mentioned that in the slide. That is now merged with AS10, property, plant and equipment, which is paragraph 40 to 60 of PP, AS10 PP mentioned talks about this. A few standards which I thought will highlight. First generation standards, I'm hoping that all of us are familiar. Disclosure of accounting policies, inventories, cash flow, contingent, events occurring after the balance sheet date, changes in accounting estimates, construction contracts if applicable, revenue recognition, property, plant and equipment, foreign exchange, government grants, investments, amalgamations. 14 are over. Now AS15 is employee benefits. In the case of a company, please know that actuarial valuation is mandatory. If actual valuation is not done, we will have to qualify the report. Have to qualify the audit report. Trust biological assets come under PPAS 10 now. Biological assets PP 10 have to double. Apparently yes, I have to double check and confirm. Yeah. So AS 15, this is mandatory, and the provision has to be made for the incremental liability of retirement benefits, end of service benefits, mostly gratuity. And leave encashment accumulated also has to be actuarially valued and incremental liability provided for, adjustments made for the payouts, etc. Now, if it is funded, in addition to the incremental liability, this is a detailed explanation, but I will briefly explain. In addition to the incremental liability, we also have to provide for, rather, if there is a dent in the value of plan assets, as I say, if the amount invested by this gratuity fund has gone down due to market fluctuations, etc., there's a dent or reduction in the value of plan assets. Our share of that also should be provided for. That will also take a hit in the P&L account. So AS 15 is a standard calling for detailed disclosures, tabular disclosures of the defined benefit plans, the interest rates used, life expectancy, all those things. Finally, arriving at the amount which is going into the balance sheet and P&L separately. AS 16 borrowing costs. Normal case, a trading company and all that, it is fully expensed. But if there are outlay on qualifying assets, which takes more than 12 months for completion, then one may have to I have a slight sore throat. One may have to capitalize that portion of the interest which is used for acquiring that asset for the development period. AS 18 related party disclosures, very often disregarded. Even a small private limited company paying 1 lakh of remuneration to the managing director or director, it will come under AS 18, and this has to be disclosed clearly. AS 22, the concept of deferred taxation, it is there from 2006, but still many of us are not able to fully understand. By AS 22, deferred tax assets liabilities do recognize and carry deferred tax assets only if there is, that reasonable certainty versus virtual certainty. Also know that unabsorbed losses and depreciation, if return is filed on time, will also result in DTAs. Lastly, AS 26, intangible assets. First is about the recognition criteria. Some of us still have preliminary expenses accumulated and write off over a period of 5 years or 10 years. It is not correct. Preliminary expenses have to be written off in the year in which they are incurred. For tax purpose, 35D, this may be different treatment, but for accounting purpose, preliminary expenses are expenses sunk and gone. Outlay does not result in any enduring benefit. Therefore, they have to be written off in the year in which they are incurred. So that is about that, the special care. That brings us to essays. I did mention essay mandatory under section 143(9) of the Companies Act. Total compliance to be ensured. I'll give a run through some of the standards which are very important, which all of us should practice. Essay 210 deals with the letter of terms of audit engagement. We must get a letter of engagement before we start the audit, signed by the management. Are we doing it? If no, please do. 220 quality control for audit work. There should be a quality, air of quality, quality policy in the firm, and primarily talking about processes and people, good quality people and good quality processes in discharging an audit. Okay. Documentation, planning, all those things. 230 is on documentation. A documentation should be sufficient to prove that audits have been done in accordance with standards on auditing. SA 300 audit planning, which mandates an audit planning memorandum, a brief, a 1-page or 2-pager. The partner and the student would sit together, or the assistant would sit together and make a master plan. And then it also talks about an audit program, an expounded detailed set of procedures, or rather instruction manual in the discharge of the audit. Mandatory, not only by the Companies Act, not only by the institute, also by the Companies Act, 143. 315, we did mention, evaluate the internal controls, understand the business to stay relevant and move on. And then based on that, you assess the risk and reassess the audit risk. 501 and 500 is evidence. The auditor should collect sufficient, appropriate evidence. Sufficient is quantity, appropriate is relevance and quality. 501, special considerations for selected items. One is inventory. We had a reference to that earlier. Inventory, we must be, physical verification should be supervised, overseen by the auditor. 510, yes, initial engagements, opening balances. 570, now it's not a major concern. Last 2 years, 3 years, we were using the principles of 570 so frequently, almost in every audit, goes without saying, it is going concern. 580, sirs, written representations. Do get management representation letter before signing the auditor's report. And lastly, we have 3 reporting standards. In fact, 4 of them. SA 700, forming an opinion and reporting on financial statements. Tells us what are the contents of the auditor's report. SA 701, for the time being, only for listed companies. Key audit matters, KAM, which we'll not discuss now for the paucity of time. 705 tells us how to qualify a report. Qualify modified report as a qualified report, adverse opinion, disclaimer of opinion, etc. All that has to be given. And that term, which we all our seniors would know, that we were using this term subject to. The new terminology is not subject to, except for matters specified in the basis of qualified opinion paragraph. The financial statements give a true and fair. SS 705. 706 is mostly for emphasis of matter paragraph and other matters too. But emphasis, we use some of the cases where we feel that this has to be highlighted, but not grave enough, not big enough to invite or rather, invoke qualification by the auditor. Yes, that will happen. I think other reporting requirements all are familiar. Oh, yeah, EPF, yes, impact of pending litigations on financial position, etc. Provisions as required in accounting standards or material for receivable losses, including derivatives. If derivatives, the client positions in derivatives, please understand what it is and make sure that there's an MTM, mark-to-market provision which is made. Mostly the intermediary would mark you for that. But then accounting point of view also this has to be ensured. And lastly, internal financial control reporting, which the institute said finally, we will not report on all the internal financial controls. We will report on internal controls on financial reporting, ICOFAR. That also now it is relaxed for small companies. They don't have to give the IFC report. Companies with turnover of less than 50 crores and borrowing of less than 25 crores, they are exempted, provided no pending AOC 4 and MGT 7. The annual filings have been duly complied with. If these conditions are satisfied, 50 crores turnover and 25 crores borrowing less than, if they are there, they are exempt. Small companies in any case are exempt. So these are the things I thought would be relevant for company audit, all you need to know. So before I say thank you, let's quickly recap. Most importantly, please familiarize with the revised Schedule 3, revised CARO 2020 requirements. As I mentioned earlier, repeatedly, I reiterate, 21-22 cannot be a copy-paste here. We have to make major structural changes sitting in front of the laptop. I ask our team, empower our team, give instructions, give training sessions. We finished that long back, 2 months back, a team which we formed. They helped me in drafting this revised CARO 2020 and the Schedule 3, new letter of representation. MRL also has been customized to include all these new reporting requirements. So then Schedule 3 and CARO 2020. I'm sure that the membership at large would embrace these changes and fall in line with this changes, though they are very demanding, onerous on the auditing profession. We have no other go as of now and reinstate the trust the system the regulators have in the profession. So with that, let me conclude by thanking Deepak, Ravi and their MC team, our regional council colleagues, Chairman Chinna, Changal, Sunil, Naresh, all of them for having me in Hyderabad. It would be my pleasure to come down anytime post-COVID. So we will surely have an occasion to meet. Till such time, let's continue to learn and keep ourselves charged. God bless the Hyderabad branch, its members, students, and the staff. Thank you once again. It's back to you, Ravi.
Sir, members are asking your mail ID, sir. Can you type in chat box?
Yeah, sure. I'll put it in the chat.
If you share anything also, we'll host in the Hyderabad branch website also, sir.
Yeah. I'll just type out and read CA Jomon K George at gmail.com. CA Jomon K George at gmail.com. I'll put it in the chat box. One way to put in Q&A also. CA Jomon K George gmail.com and this also.
The request chairman, sir, to please give his remarks.
Thank you, Johan sir, for an excellent presentation. I could easily understand the command on your subject, in 2 hours in a simple language, you could cover everything.
Thank you, sir. Nice to hear that. Yeah.
Right from auditing standards, standards on assurance. None of your slide had any technical this one. It was lucidly presented in a simple language, but backed by the technical and requirement which we need to report in our report.
I would
Seriously,
give the credit. I would give the credit to my 10,000 students. I've been teaching for 20 long years, and they always used to ask questions, which kept me learning. And today, any change that comes, there is an academic culture which charges me to learn. Thank you for the compliment, sir. I leave up. Thank you so much.
Sure. Thank you so much, sir, for your wonderful session. And thank you all
Since
for-
our Sikasa chairman Saran Kumar is there, I request him to give his vote of thanks.
He had made a lot of observations, sir, and I should thank you first.
Yeah.
Shortcuts for the members of
Yeah,
Hyderabad.
that's why I asked him to give his vote of thanks.
If I get a chance, probably I can just quickly show that with the permission of chairman and speaker, I'll just quickly show one shortcut tip of Excel, how to convert quickly into the hundreds.
Please,
Jaman,
sir.
sir, can I?
Sir.
Yeah, I have no issues. Please.
Yeah, it is actually a very simple shortcut, sir, for the benefit of the numbers. For example, when I have the bigger numbers, like let me have like this. Instead of writing bigger formulas and so on, what we can simply do, we can put 100 here, or 100 or 1,000, whatever the case it is, copy, and just select this data, paste to special. There is an option called divide. Once we click it, everything will turn into the hundreds. Okay, 100 multiples.
Oh yeah, that's good.
That is a very quick way of doing it. I suggest the members at the trial balance level, probably they can convert everything into thousands or hundreds, as the case may be. Then they can present the data so that the same values will flow into the entire balance sheet, P&L, and the schedules. Thank you so much, sir, for this
Thank you, sir. And now please propose vote of thanks to sir.
Yeah.
Chairman is
Chairman, sir,
something.
you are saying something.
Yeah, Santosh, please share the certificate.
Yes. Before vote of thanks, please share the virtual memento. Santosh. Sir, once again, all our committee members are very thankful to you.
Thank you so much.
Thank you
Oh,
so much.
nice. Thank you.
Sir,
We'll go
on behalf of
into
the
my collection. Thank you so much. Ravi, what about the Q&A?
That member will answer while exiting from the PLX, sir.
Okay. My job, I don't have to involve. I had sent the questions yesterday. Yeah.
Yeah.
I should thank Suma also. Who has been a great support because
Yes.
I sent an audio from the hospital yesterday, and then she
Oh.
only typed it out, and then she was very supportive. Thank you, Suma, for. So she has also been a colleague in SARC.
Yes, sir.
Yeah, got her back into Hyderabad. She should.
Yes, sir. Luckily.
Thank you. Please, back to you, sir.
Yeah.
Sir.
Yeah. Thank you so much, Jaman, sir. In fact, I have been in the entire session. It is very interactive and very informative. I thank on behalf of the Hyderabad branch of SARC of ICI. I thank all the staff who supported this entire program, and I thank Ravi Shankar Reddy, secretary, and our chairman, sir, who always would like to get more interactive sessions than very, very old traditional sessions. So thank you so much, Uma ma'am, and all the staff who supported this entire session, virtual session. Thanks to all the participants. In fact, I was just seeing it. It is consistently 50 all the time. So I'm sure this may be just 50. Once we upload the presentation, the downloads will be much bigger. And I request all the participants, please download the Hyderabad branch of SIRC mobile app also, so that all the presentations and everything are part of into the mobile application. Thank you so much once again for this opportunity. Over to you, Secretary, sir.
Thank you, Ravi.
sir.
Before you take up, I would right away, before logging out, I'll right away mail this presentation to the Hyderabad branch.
Sure,
You
sir,
can
sure,
have
sir.
it on your website. Members
Yes,
can draw
yes.
it, and then
Mobile
mail
app
across
also.
also. I'll leave it to you.
Yes,
Yeah.
yes.
And somebody
Yes,
has
sir.
asked for my mail ID in Q&A. Sir, chat disabled. Hence, using this mode to thank JK George. Okay, chat has been disabled. Okay, no problem.
CAJomonKgeorge@gmail.com. CAJOMONKGEORGG@gmail.com.
Thank you.
If anybody want to have his number also, you can reach me out. Once again, I thanks all the participants and speaker and chairman, Sharon, everybody. Now I request members even please join for the program on day after tomorrow. We are celebrating Teachers' Day celebrations. Rajkumar Adikia sir is CPE committee chairman is addressing members and students, and we are felicitating all the teachers. Now we have another one-day program on 10th of this month, 10th September from 2 to 8:30 in FAPSI. It is on purely on direct tax tax audit. I request all the members to register. Thank you, sir. Thank you so much for joining.
Thank you, everyone.
That's all for the day. Thank you.